Kurt Peavy with Arthur J. Gallagher. I have been in the industry since 1998, so that means I'm old. But this is all I've done since I've graduated from college, is work in the retirement and investment industry. So have done quite a few different employee training modules for Selden over the past 10 years and look forward to doing many more. This one today is going to be kind of investing 101, kind of the basics of investing. So the agenda, and some of this I'm going to run through kind of quick because it may not be as pertinent. Some of these pages I'm going to spend extra time on just because of what I think might be more valuable to you all. So we'll cover the foundation of investment strategy, investing basics, which I will spend the most time on, and then portfolio design and the power of staying invested, which the charts will kind of speak for themselves, so I won't cover those too in depth. So what makes an investment strategy? And really the four key pillars would be investing entails developing a plan to meet your return objectives. And that's the one that most people struggle with the most. Just like creating a budget is difficult if you've never done it. Creating a plan for investing is difficult if you've never done that before. Again, Fidelity, more than any other record keeper out there, has the best tools and resources available for that. And then balances opportunity for gain against volatility of values. Again, the more risk you take, the more potential reward, but also the more potential losses. And then design a well-researched approach to construct and management of your retirement plan, and then closely monitor for changes in market, economic, or investment conditions that would require change. Now, this one says closely monitored. I would argue that that can be a little misleading for the average participant and the average investor. Not watching your account on a daily basis, or really even on a weekly or monthly basis, will do you far better than checking your account balance all the time. That's when we start to get let emotion override our decisions, and then we start making bad investment selections. So what are the three different goals that we put in here? Short term, 0 to 5 years. And the biggest one that we really try to hit with most participants is the emergency fund. I believe statistically, 70% of Americans don't have $500 in emergency savings. So this is one that would definitely be, if you don't have one, I think is extremely important, and it also helps keep people out of debt. So for instance, if you have 2 flat tires, if you've ever driven in Texas, our roads are full of potholes. And I've actually blown out 2 right tires on the interstate by hitting potholes with my car. Tires cost about $250 these days. So $500 in emergency fund would covered essentially replacing those 2 tires as an unexpected expense. And then also saving for large purchases such as a car or a home. So those really should be your short-term goals of anything you're going to do within 0 to 5 years. Intermediate term goals are goals that are going to be about 5 to 10 years out, and that would be education funding if you have kids that you want to send to college or to say private school, and then also home ownership. These days, with just the price of homes, most first-time home buyers don't buy their first home until they're in their 30s. I was 32 when I bought my first home. So 5 to 10 years out for the average person in their early to mid 20s, that could be a real goal and objective of yours, is to buy a home and to start saving early for that. And then your long-term goals are going to be really retirement planning, saving so that you can comfortably retire one day, debt elimination, which we're going to cover that in greater detail, paying off outstanding debts such as mortgage, student loans, credit cards, any other liabilities, and then funding personal interests and passions. So that would be if you want to eventually take, a month-long trip to Italy. Everybody's kind of passions and desires are different. So going to Italy may not be of interest to somebody, but for somebody that may be a lifelong goal. So those are really the 3 different goals that you should start planning for and saving for. This one I want to briefly cover because retirement accounts, you already have the 401k available through Selden, which does offer an employer match. So now, where it comes to the average participant, and when I say average, statistically, 95% of all people who invest in their company's retirement plan claim that they do not consider themselves to be very good when it comes to understanding investments. And it's not surprising because I've been in the industry for almost 30 years. And there are times where the different types of investments out there were definitely confusing to me when I started. And so I understand that I've been in this industry. I do this all day, every day. And sometimes I even have trouble explaining it to other people. So I can completely understand how the average participant, and that's 95% of you all, probably get a little concerned when choosing investments. A lot of people, their biggest concern is making a wrong decision and then losing out on their savings. So, because of that, and this is one of the reasons I'm very happy that Tyler Kent from Fidelity is going to join. But when it comes to the general type of investor, there's two types. One is the do it yourself, and that's not most people. This would be somebody who wants to do the research, pull the list of every investment offered in the retirement plan off the Fidelity website, and then picking and choosing the investments that they feel are the most appropriate for them. Typically, this requires education, skill, time, and emotional control. And when I say emotional control, I'll get to that towards the back of the presentation, why the average person is better typically by choosing either a target date or letting a fiduciary make decisions for them, which Fidelity can do for free. And then you can also do the professional managed. This can either be for free using tools and resources through Fidelity, your target date funds that are offered within the plan, or in some cases, some people might hire an outside financial advisor. But this is for people who preferred guided, advice-driven approach. Now, this is the reason when I start getting a little bit deeper in here as to what causes the most confusion for the average person. And I will jokingly say that my brother has a PhD, but he does not still, at 2 years older than me, so he's 52, has no idea the difference between a stock and a bond, no matter how many times I've tried to explain it to him. But there are two, and this is general, types of investments that you're going to run into. And keep in mind, there's a lot more types of investments, but for the average person who just wants to save money, earn some interest, not take too much risk, these are the two types of investments that people will see most inside of mutual funds. So you have stocks. The easiest way I can explain this is when a company is founded, it can be either public or private. Somebody owns that company. So if I were to say open an LLC and just say for lack of a better idea, I'm going to be selling retirement investment education 1-hour courses to the general public. And then based upon how many of those I sell determines what my revenue is. So I may sell, I'm just going to use random numbers, $100,000 worth of those classes. My expense, including what I earn and all of the expense costs that I have, say that's $50,000. That leaves $50,000 in profit for my company. And this is very generalized. Okay. So if I have one share is all the company has, that share is essentially worth $50,000 because that's what the earnings were for that year. Now, most companies have more than one shares. There's oftentimes more than one owner. And so I could, if I want to sell pieces of my company, say it's become very profitable. I'm making $1 million a year in revenue. So if I want to potentially sell portions of my company, I could split that one share up into 10 shares. And so each of those shares is now worth $100,000. So the once I start to sell those shares, if I'm a private company, it's really based upon the earnings of that company. And so if somebody wanted to buy a part of my company, they would give me $100,000. I now own 9 shares of my company. Somebody outside of me owns 1 share of my company. Under the same scenario, if the company makes $1 million, I make 900,000. The person who bought the 1 share makes 100,000. And then the prices tend to fluctuate by company, performance, market conditions, and economic factors. This is mostly going to be targeting publicly traded companies, but I don't want to not discuss privately held companies. And then publicly held companies that have public shares are typically traded on exchange and generally higher risk than cash and bonds. Now, when it comes to publicly traded companies, the way that they're valued is different than privately held companies for the most part, because um, for private companies, you're really buying the earnings of that company. For public companies that trade on the stock market, you are essentially taking a risk, either that you feel that the company is going to continue to grow and continue to earn more money, then it's the desired or the amount of people that want to buy into that company. So the company is more favorable. More people want to buy that company's shares. Take for consideration Apple Computers back in the day. Their stock was very low at one point. People saw the long-term ability of Apple to make more money, and the stock increased as there was more interest in buying that stock. So public companies, they are much more volatile than private companies. But private companies really aren't going to be relevant in this discussion when it comes to the 401k. So public companies, just the ownership of that company, anybody can buy shares of a publicly traded company. You can go on to a lot of different trading websites. And if you wanted to buy shares of Apple Computers, you can. You can look up what's the price of Apple today. I don't know at all what the price of Apple is. I do know, just for instance, if it was $100 a share, if you had $100, you could buy one share of Apple. And so then you can buy as many shares as you have the money to buy them. Now, when it comes to bonds, this one becomes a little bit more confusing for the average investor, but it really shouldn't, in my opinion. A bond is no different than a mortgage or a loan that you would get. So if you're going to go buy a car, most people don't have the ability to write a check to pay for that car. So they're going to take out a car loan. And then that car loan, for kind of all practical purposes, there's a lot of different factors that go into what the rate of that car loan is going to be. One is, what is the overall interest rate environment? What are the banks willing to charge? And then also what your individual credit score. So I'll jokingly say I don't have a twin brother, but just say if I did have a twin brother, our car loan would be a different interest rate depending upon what our credit scores are. So if I have a really high credit score, but my brother has a really bad credit score, the interest he's going to pay is higher than the interest that I'm going to pay, because my credit score with a high credit score, I'm deemed to be worthy. So a bond is really just a loan. So again, I'm just going to keep picking on Apple Computers. If they wanted to build a new manufacturing facility here in the United States, and just say, I don't know what the cost of that would be, $1 billion. They're probably not going to have $1 billion sitting in a bank somewhere. So what they're going to do is issue a bond. Now, that bond can be bought by as many different people as outstanding shares of that bond. So out of the $1 billion, the bond shares may probably be about $1,000. So if you have $1,000, you could buy one share of that bond. And what the interest rate that bond is going to be paying is determined upon a couple of things. One's going to be the credit worthiness of Apple Computers. So just like we have individual credit scores, companies have ratings that are given by outside rating agencies. Just like there's multiple rating agencies for consumers, there's multiple rating agencies for companies. So how trustworthy and how solvent or financially viable is that company is one of the big determining factors. Apple is considered to be a very profitable company, so the amount of interest they're going to pay on that loan will be generally small. Also, the length of time that the bond is issued. If it's for a very short period, say 1 year or less, the interest on that's going to be very low, because the risk on a short-term bond is also going to be low, because for the most part, there's not a lot that's going to change in the course of 1 year, barring any major unforeseen events. If a company doesn't have a very good rating on the company themselves, they'll pay a higher interest, and also the longer duration of the bond. And by duration, that's the amount of time until the bond matures and it's no longer outstanding, and they pay you back. So the longer the duration, the higher the interest rate. So what happens with the bond? If you have one share, is at $1,000, and the bond's paying 5% interest, you would get 5% interest on that $1,000 paid at the end of the duration of that bond. So if it's a 1-year bond at 5%, you give them $10,000. They're borrowing your $10,000. Once the bond matures, you get back $10,050. So you've earned 5% on that 1,000. That's 50,000. That's $50. So you've earned 5% or $50 on your $1,000. Those are traded over the counter and generally lower risk than stocks. And I'll get to that here in a little bit greater detail. Now, when it comes to these two types of investments, I'm not going to cover the exchange traded funds. Those are not really viable inside of a 401k plan, mainly because 401k plans only do transactions at the close of market. Exchange traded funds are intended to make multiple transactions throughout the day. But all that said, when it comes to investing inside of a retirement plan, a lot of people like the idea, right, of stocks. There's a lot of potential money to be made. Stocks are what makes up the S&P 500, the Dow Jones, the NASDAQ, and you can oftentimes see some really big returns on companies, just like, for instance, NVIDIA. Big on AI. Their stock price has been skyrocketing lately, and who doesn't want to make a whole lot of money off of their investments? The problem, though, is that if you only own one company, stock in one company, there's a lot of risk involved in that. Because if that company, for whatever reason, NVIDIA, their stock really saw a huge sell-off recently when China claimed that they were part of an antitrust violation, and their stock really plummeted. So to manage the risk for stocks, what happened about in the 1920s and 30s is companies started pooling together money, which is a mutual fund. It's just a pool of a bunch of different investors' money that's mingled together. And out of that pool, they buy multiple different shares of stock with multiple different companies. So, for instance, you have large cap stock or large cap mutual funds. Those only invest in large companies. You have mid cap mutual funds. Those invest in medium-sized companies. Small cap, as you can imagine, invest in small companies. International, invest in international. Domestic, invest in stocks here in the U.S. And the way that this manages and helps even out the risk is that a typical mutual fund will own shares in about 100 to 200 different companies. So some of those companies may see huge gains in their stock price, which is great. Some companies may see some big losses, not necessarily good, but when that risk is spread out over 100 to 200 different companies, you're not going to see all the gains of that one stock, say, for instance, NVIDIA. But if a company has some really big losses, or if a company goes bankrupt, you'll see some minor losses, but it's going to be very minimal compared to the overall holdings of that mutual fund. It provides a broader diversification compared to owning an individual stock or bond. So mutual funds may have technology stocks in them. They may have manufacturing stocks. They may have what's considered consumer goods, things that we buy at Target and stuff like that. They are professionally managed. So you have people researching companies every day. They're buying and selling shares of companies on a daily basis. They're designed to follow a specific theme, which is why all mutual funds are given a name and then what they consider a Morningstar category, and that's going to be large cap growth. And that means they're going to invest in large companies that are expected to have significant growth, are large value, large companies that are deemed to be undervalued, that they see that the chance for that undervalued stock to appreciate slowly over time. and then trades once a day at what's considered net asset value. Don't want to get into too much detail over that, but you see a price of that mutual fund every day at the close of the stock market, which is 3 o'clock Central. So mutual funds are really just a pool of thousands or millions of people's money that are invested in multiple different companies. That allows you greater diversification. It allows you access to companies that you may or may not have even been able to afford on your own. I know myself, I think NVIDIA went, oh gosh, several $100s per share. I'm not really comfortable paying several $100s per share for one share of one company. And so I like the idea that if I'm going to put my money into a mutual fund, that money is spread out by a bunch of different types of companies, a bunch of categories, and it allows me to potentially grow my money while evening out some of the risk involved by buying shares of just one company stock. Now, if it's not just that you have to understand all of that, once you get an understanding of the different types of investments out there, if you're a do-it-yourself type of person, then you have to start looking at what is going to be your portfolio and what's going to be your risk tolerance. So these are the different subcategories of the investments that we talked about. So cash, we all know what cash is. Cash is cash, right? Then you have, when it comes to bonds, you have multiple different types of bonds out there, which gets a little bit more into the weeds. There's more than four, but there's more than three. These are the three most common, and those are going to be U.S. government bonds. Those are just bonds issued by the government so they can support spending. And those are going to be deemed the safest investment in the world because the government can print cash, and it does. You also have U.S. investment grade corporate bonds. So these are going to be deemed companies that have a good credit rating, and these are issued by private companies here in the U.S. Also deemed to be a pretty safe investment. You don't often hear of companies, especially large companies like Apple Computers or Google or somebody like that going bankrupt. It just isn't common. So bonds are pretty safe. And then you also have high yield bonds, which used to be called junk bonds. The industry changed the name to make them not sound quite as bad. And they're not horrible investments, but these are companies that maybe aren't as financially solvent as some of their peers. There's more risk involved that this company might go bankrupt eventually. And those are called high yield bonds because they have a lower credit rating. And that lower credit rating means they have to pay a higher interest rate. To get a little bit more deep in the weeds, you then have different durations of each of those three subcategories. So even with U.S. government bonds, you have short term, which is usually about 1 to 2 years, intermediate term, which have a pay date of about 2 to 7, long-term bonds, which will pay out for 7 years or longer. Same with corporate bonds, and then high yield. So there's a bunch of different subcategories in just those bonds themselves. So for do-it-yourself investors, they really need to take a look at what's out there, what's offered, not just in the 401k plan, but in general, if they're making purchases of stocks or bonds outside of the 401k plan. And then when it comes to stocks, these typically have higher risk. And one thing I was going to mention, if a company does go bankrupt, people that hold bonds are considered a creditor. They get paid before people who own stocks. So people who own bonds of a company that went bankrupt, they'll probably get about 80 cents on the dollar for their holdings. And companies don't go bankrupt that often. So it doesn't happen often that people lose money on bonds. It's possible, it's just not common. And then if you hold stock in a company that goes bankrupt, typically you may get about 10 cents on the dollar. But there's more potential growth in stocks because bonds have a set price of what they're going to pay out, which is the earnings. Stocks fluctuate on a daily basis. So as I kind of briefly mentioned before, you have the different kinds of stocks, which is U.S. large cap. And from there, you have large cap value, large cap blend, large cap growth. You have US small cap, same value blend growth. This doesn't list US mid cap. There's just not enough room to put all the different types of stock categories out there. You have developed international markets, you have emerging markets. There's about 9 to 11 different subcategories when it comes to stocks. So again, the average person, if they are a do-it-yourself investor, really needs to take a category list of all the different options that they have available to them, determine what they think is going to be in their best interest, which will be based upon how much risk are you willing to take, and then make decisions on allocating the money they have available into buying either those mutual fund bond mutual funds or stock mutual funds. I'll admit that I could probably spend 8 hours going into detail about the different categories to try to make it make a little bit more sense. I understand that, and I like to be very realistic in a kind of a condensed time frame. If this doesn't make sense to you at all, don't feel bad, because 80% of people are not going to get a great understanding off of a 1 hour learning class, which is why Fidelity has so many other tools and resources that you can use at your disposal in your free time to help get a better understanding of this. So then also when it comes to the portfolio design, I'm going to skip over this page. This page I'm only going to cover because I think it's very interesting. It covers why you should never try, or the best people can never time the market. If they could, Goldman Sachs would do that, and they would be making billions of dollars for everybody. But this shows you what category of stocks did the best in multiple different years going out over the past 10 years. So last year, growth stocks were the best. They came in at 33% rate of return. In 2023, growth stocks also were the best with returns of 42, almost 43%. 2022, growth stocks were the worst, coming in at a loss of 29. What's interesting is that the types of asset classes that have the highest rates of return in any one given year when the stock market is good are usually those that have the worst performance in years when the stock market is bad. And then you can see those that have kind of medium performance are those that typically stay right in the middle. So balanced portfolios, which are mutual funds that hold 60% stock, 40% bonds, they don't really fluctuate that high and that low. They just kind of track in the middle. Same with hybrid bonds. Small cap gets very volatile. And then global stocks also, you can see, never usually the highest, never usually the worst, but they do fluctuate greatly. So nobody can predict what's going to happen to the stock market in any one given year. We can make assumptions, but even the best assumptions are often wrong, just based upon news, based upon what's going on in the industry, etc. So then to add, unfortunately, even more confusion. Once you've got an idea of what investments are out there, then you have to determine what is your risk tolerance. And that's going to be, are you willing to take a lot of risk because you're young and you want your money to grow as fast as possible because you have 30 to 40 years to retire? Or are you very conservative? Are you not willing to take a lot of risk? Maybe you're older like me. You're about 10 to 15 years away from retirement. So you do want to earn money on the money you invest, but you also don't want to lose a lot of money. And so these are really the 5 different categories of investors. You have a conservative investor. Their primary goal is capital preservation. And even if the stock market is up 30% this year and you only earn 10, you're okay with that. Because if you think back to 2022, when the market was down 33%, a conservative investor might have only lost 10. So you're willing to give up returns because you don't want to potentially lose a lot of money, which could set back your retirement goals. The moderate conservative investor, primary goal is to preserve the money they have, but they're willing to take some risk because they do want to achieve some gains. most people I would consider to be a moderate investor. They don't want to take extreme risk, but they want their money to grow. So they're willing to take a decent amount of risk for higher than average returns. And then you have moderately aggressive and then aggressive. On average, and this is just generalizing, the older you are, the more conservative you should be. The younger you are, the more aggressive you should be. The reason being is that if you're 25, you have, and I hate to ruin anybody's Thursday, you have 40 years to retire based upon Social Security. So you want to make as much money as possible. You're going to start out with small balances in your 401k plan. You're going to start contributing in there. $100, even if it earns 20%, that's going to be $20. So now you have 120, 20% rate of return is great, but $120 isn't going to get you to retirement. So you want your money to grow as high as possible. You want those each payroll deferral to go in, keep earning money. That money appreciates, it accumulates. And so you want that money to continue to grow. If you lose 30% next year, you shouldn't worry because you have 38 more years to go. And on average, every 9 years, the stock market gains. Every 9 out of 10 years, the stock market gains. Every 1 out of 10 years, the stock market loses money. So keep in mind that the aggressive investor, the younger investor, they're okay with those risks because they know even if I lose money next year, I'm going to make money probably the year after. As the conservative investor, those should be people who are close to retirement. So this is where it makes it even more tricky is that if you're a do-it-yourself investor, if you start off aggressive, every couple of years, you need to be moving your money around. You need to maybe take a little bit of the risk off the table, maybe go into less aggressive stocks, maybe not as much international, maybe not as much large cap growth or small cap growth. Maybe you want more value mutual funds to help moderate that risk. So that does take time and effort. The one thing I'm going to and Christy, do we have Tyler on yet?
We do. Yes.
Okay. So I'm going to wrap this up here pretty quickly. When it comes, I have a pretty good idea that I've confused a lot of people, right? I know that I do these in person often. It makes it a little bit easier, in my opinion. But that being said, since the average participant and the average investor, when they're given all of that information on hand, they kind of start to panic, like, I don't know how to make a decision to invest my money. Because of that, the industry came out with what's called a target date fund. What this does is it gives you automatic diversification and an automatic risk tolerance and automatic de-risking as you get older. And so I'm going to explain it this way. If you are, say, 25, target date funds have a vintage date at the end of them. So it could be a 2025. That's for somebody who's about to retire this year. A 2030, that's for somebody who's retiring in 5 years. A 2040, et cetera, et cetera, et cetera. So the date at the end of the vintage is the estimated date that you're going to retire. So a 2065 or a 2070 target date fund is for somebody who's going to retire around the age of 2065 or 2070. These are generally going to be your youngest participants, and those are going to have the most risk. It's usually about 85% stocks, 15% bonds and cash. They're professionally managed. They're spread out through multiple different categories. They have bonds, stocks, both large cap, mid cap, small cap, international. And then every approximately 5 years, the portfolio managers, the professional money managers automatically take some of that risk away and move it to less risky investments. There's nothing that you have to do. It's all done for you. There's no additional cost. And oftentimes they are the lowest price investment inside of the 401k plan. So all that being said, Christy, if we want to set up another call to go over maybe a little bit more in depth on just the different types of stock of mutual funds, we can do that. But I do want to take time to turn it over to Tyler because outside of just the target date funds, which you guys have available, about 90% of all the money in the 401k plan is in those target date funds. So you guys are already diversified. You're already having your risk managed for you, becoming more conservative as you get older. Nothing that you have to do. But Fidelity can take it a step farther by offering direct advice. So if you call Fidelity, not Tyler, but if you call Fidelity and you'll get their general service people, if you want to think about doing it yourself, you can ask for advice. Fidelity will transfer you to a registered investment advisor like myself, not me because I don't work for Fidelity, but they can ask you questions, gain your risk tolerance, and then give you direct advice at no cost.